Hello and welcome to this new edition of the Candriam Academy ESG Talk. This is, as you will remember, Candriam's initiative to provide knowledge about ESG to the wider investment community, anchored in the Candriam Academy, the online free platform to learn about everything ESG. The topic today is engagement, shareholder engagement, corporate stewardship. There are different ways to refer to it. It's been a growing topic within the investment community, and I'm thrilled to have with me today to discuss this topic. First, Clare Richards. Clare focuses on engagement within the investment team at the Church of England's pension board, which manages the fund for 40,000 Church of England members. She contributes to or leads the board's involvement in various investor collaborations on environmental and social issues, with a key focus on the issue of corporate climate lobbying. Welcome, Clare. And secondly, I have with me today Wolfgang Kuhn, who is Director of Financial Sector Engagement at ShareAction, an organization set up in 2005 to improve corporate behavior on ESG issues. And before working for ShareAction, Wolfgang managed for over 20 years bond portfolios. So I think it would be best place also maybe to share some thoughts about engagement in the fixed income space. And Wolfgang, welcome. Unfortunately, the third member of our panel, Paloma, who was announced, had to decline at short notice for a very important work engagement she had to attend. But I'm sure we'll manage the three of us to have a very interesting discussion nonetheless. A few words about logistics before we get started. This session is being recorded. As you will remember, you have the option to ask questions during our discussion using the Q&A button provided by Zoom. And as we go along in the discussion, I will check the Q&A box regularly and feed the questions to our panelists. And we will try to cover as many as possible. So please feel free to really write what you would like to discuss, and we'll try to do our best to accommodate that. I think I haven't forgotten anything in terms of logistics. So first I will introduce very briefly what engagement is for those of us who might not be as familiar about it, and then we will move on to our discussion properly. Engagement is, as I said, often referred to also as corporate stewardship. It starts from the simple idea that as investor, we hold a certain sway, certain influence on companies we invest in. First of all, we hold, if we invest in their equities, shares that give us votes at their shareholder meeting. And this influence, we can use it to foster change, improvement at these companies. So there are several objectives that can be pursued by engagement. One of them, and that's probably the first one that drove engagement, was to get better information from companies about their working conditions, about their environmental practices, or even about governance-related topic. The second objective goes a bit further and seeks to influence companies, try to lead them to more sustainable practices on the ESG front. And there it comes very nicely combined with vote. Vote can be seen as the once a year, usually, exercise of a certain policy, a certain objective that can be then pursued throughout the year by regular contact with the company's management, with the company's investor relations. And the topics are very broad, as we will discuss today with Clare and Wolfgang, and are usually linked to the most acute challenges that we face collectively today, one of them being climate change, another is protection of human rights, improving of working conditions, and so on. As you see, these are all hot topics. There is really nothing bigger than what the engagement is about. And this is what we're going to discuss now. So I'll start with you, Clare, if I may, with a first question, and then Wolfgang also can, of course, at any time jump in. And the question I'd like to start with, which is probably the one everyone has in mind discussing engagement. So engagement is about discussing with companies, trying to convince them to bring change. Does it work? Meaning, does it really bring change? There have been a few, of course, recent examples where investors have touted the fact that they brought change in companies. Companies improved their practices. These are the examples that we like as investors to highlight to show how effective it is. At the same time, we see that in many areas, there are still many companies that are lagging seriously on different fronts. So from your point of view, and maybe you also bring in the view of you gain from the working at the Church of England, and do you think it is working?
Thanks, David. I mean, yeah, good question. And I think, I mean, certainly I wouldn't be doing the job that I do if I thought that it didn't work. I think, I mean, sometimes, change can maybe happen more slowly than we would want, or certainly be more incremental. But where investors identify an issue that's material, so by material meaning that it really has a financial implication for their investments and for the company's kind of financial health, in identifying an issue like that and really robustly engaging over the long term, doing your homework and putting a clear case to the company, engagement can and does work. I've seen that certainly evidenced in engagements that I've worked on directly. I think the tricky thing, I mean, the sort of causation or correlation kind of point that you made, I think the tricky thing is that no company really likes to admit or be seen to be beholden to even its owners' interests or being told what to do by its investors. So there certainly can be a bit of a tricky balancing act to manage there in trying to lay claim to something, but whilst being, honest about the fact that any change that comes about is the product of many different types of influence, be it, the risk of regulatory change, reputational, the thoughts of internal stakeholders, so the company's own workers. But definitely where investors kind of pick a topic and identify internal allies as well for that issue, I think engagement can work really, really well in generating understanding and bringing about commitments that then translate into actual improvements in how the business performs.
Yeah, there have been examples recently of exactly what you just mentioned, companies where there were some internal relays for the objective the investors were pursuing, and that ended up maybe being more effective. Can you elaborate on that?
I'm not sure exactly what example, and I don't, I'm sure you can add that in, what example specifically you're referring to, but I know, I mean, that there are engagements that I've worked on previously where in raising an issue on behalf of a group of investors with the company, that really gained traction because it turned out subsequently, that there was a very well-informed internal staff member who'd been trying to get attention to that particular issue for a long time. They said they had a white paper, on the CEO's desk or in his inbox, which had just not got attention. But then because a group of investors approached about it, it gave him the kind of power and the agency and the airtime internally to be able to put that case forward, and that kind of combination of different stakeholders. And you see it working very well as well, I think, when you have well-informed civil society actors raising kind of the temperature or the issue in the media, and that can help to inform engagements as well that investors are instigating by kind of pushing it higher up the priority list in terms of what neglecting to kind of act on that could potentially mean for the company. Yeah,
like essentially you're saying there was a kind of whistleblower, or it didn't come out as publicly as a whistleblower, but had really started to be the case.
It was their pet project, and it was a very sensible pet project, a sustainability, a future kind of proofing exercise, but it required the allocation of capital and internal resource. So it just hadn't, it hadn't quite got the bandwidth, the priority internally. But no, not a whistleblowing, actually a positive kind of partnership, really.
For example, it could be someone, for example, working at an oil and gas company, just being an example out of the blue, who had a pet project to develop some kind of renewables, but wasn't really being listened to. And then thanks to investor, got to, I'm not saying that's what happened, but got to bring its case forward. Okay, thanks for that, Claire. Wolfgang, turning to you, from your perspective, both as a former bondholder, but now mostly as working at ShareAction, do you think engagement brings any value?
Well, I've for 20 years sat on the bond investor side, and I had my equity colleagues a few 10 yards away, and I've always considered them the owners. And I know there's a discussion about whether equity holders are actually the owners or not. From my simple bondholder mind perspective, they are. And in a way, you are asking, is it possible for the owners of a company to tell the company what to do? And as a bondholder, I would say, well, I'm pretty sure it is. But it's a bit more difficult than that. And I would say, yes, of course, engagement can be very effective. It's a question of making clear what is wanted and making clear what happens if what you want is not resulting or is not coming out. From our perspective, and ShareAction is almost, the majority of what we do is about telling investors to be more forceful with companies so that companies become more sustainable. So in a way, we could say we're all about engagement, and most of what we do is tell investors, you need to raise your standards, because what you're asking companies is just not specific enough and ambitious enough. And it's the one big issue is that when we talk about engagement, you said it in the not so long ago, engagement was about gathering information. That's what we on the bond side call engagement. And why would you not want to get more information? The problem is now we have a few more issues and we want to go faster. And it's just not enough to do what we like to call tea and cookies engagement, is sit down and have a chat with the CEO or the treasurer and say, how do you see this? And these are our concerns. And then management goes away and we meet again in a year's time. That's how many investors, and I don't mean Claire and her employer, because for sure Church of England is part of maybe a dozen of investors who drive this very, very effectively. But a lot of investors still think that if they show you the hours or days that people have spent on talking to companies, that is in any way impressive. And it really isn't, because it's not about how much time you spend, it's about how effectively you make asks for change.
Yeah, that makes total sense. It's the result, right? And not just a question of means. Anything you want to add to that, Claire, since you were mentioned?
I mean, I would agree with that, I guess. I mean, in terms of the amount of time, I mean, the engagement meetings themselves are really, they're the tip of the iceberg. It's the homework that you put in from gathering data from a variety of sources, of kind of checking what the position, the pre-existing position and public statements of a company are on particular issues, how that compares with their peers, so that you can kind of understand what's possible, and also where they kind of sit in the overall market, so that you're kind of asking the right stretching questions, because certainly it can be frustrating if you're then granted maybe a half-hour meeting on some particular issue, and then that sometimes some companies, their IR teams their investor relations teams, not in all companies, but in some companies, that that they're kind of paid to be gatekeepers. They're paid to the role that they fulfill is, say, weeding out maybe some of the inquiries that they get, and trying to kind of do triage like you would in a hospital, kind of getting rid of the easier cases maybe, and not taking up the time of the actual specialists. And you need to get through to the specialists, and then you need to get through to the decision makers, the kind of higher levels of the company. And to do that, you have to have a kind of credible engagement plan. And I think that's where the value of coalitions and kind of collaborative investor engagements, and also partnerships with other kind of groups comes in, to be able to draw on different resources and strengths and data kind of points.
So basically, you give us here a very good piece of advice for anyone who is watching and wants to start engagement. It's do your homework, be super credible about your knowledge on the company, the challenges it faces, the option it has, before reaching out to the management and seeking an audience, right? And Wolfgang, I saw you raise your hand. Is it because you wanted to add something?
No, I mean, I agree with everything, and having a plan, which is, really important, because saying after the engagement you've been successful if you haven't had a plan is a bit difficult to judge. Not that that's the only important thing, but I'm raising eyebrows when you say make sure you look super informed. I mean, that definitely helps not to look ridiculous, but I think it's not the job.
Good mantra for life.
Good advice for life. Yes.
Not that you would. I'm thinking about myself. It helps. I've had engagements in the long past when I didn't really know what I was talking about. It does help, but it's not the job of the investor to know the business better than the manager or the CEO. I think we have got a very good piece of advice yesterday from the IEA what needs doing, and we don't really need to have to explain to a CEO every page of the IEA report.
Okay, sorry, I pause you here. IEA report, we need to explain what it is.
Okay, sorry, the International Energy Association has come up with a new pathway, a new way how we can get to a zero emitting world in 2050, and this is was seen as a bit of a revolution, because it requires to phase out fossil fuels much faster than everyone thought. So, but that's actually not my point. My point is, Claire talked about questions and putting questions to the to management, and I'm thinking engagement should now go further. It's not just about questions; it's about telling them what to do. And of course, there will be many people, and we hear that all the time, that say you can't tread on managers' turfs, it's their job. And I'm thinking, if I hire a gardener to prune my trees and they walk towards the wrong trees or start cutting them, I'd probably say something, and I wouldn't say, oh, it's the gardener. I don't want to tread on their turf. They are the experts. Give you another example. An executive told me this week that we are at the beginning of this. You need to have a little bit of patience. We get up to speed with all these pathways, etc., climate, everything. And I'm thinking, well, we are NGOs. We're not at the start of this. We have done this for decades. We've told you for decades what needs doing. So if you starting out now, why don't you let us drive for a while? These are big systemic issues. And if management just still hasn't quite got it, they can't at the same time push back and say, but I know how to run this company. They may know that from day to day, and I can't run a FTSE 100 company or a FTSE 100 bank, but I know the issues that need addressing. And there is too much of this, oh, I'm a lot smarter, and I know a lot more, and I have a lot of power. I think we should not get intimidated. Maybe that's an important point for your, what to do. Let's not get intimidated by people who've done the same stuff for a very long time.
I can hear people clapping here.
If I could just add into that, I mean, I think also what we're talking about here is a very wide range of different engagement topics and different types of engagement drivers. So that the type of thing that Wolfgang is talking about there are where there are, clearer external standards and targets and sets of expectations, and investors are forever doing this and need to be doing this, which is being very, very clear in defining what their expectations are collectively, so that there can be a kind of coherent collective voice and push for those standards in engagement meetings. But there are also other types of engagements, which would be where you are kind of stepping aside from the climate side of things for a moment, where you would be using an engagement, an initial perhaps letter kind of fishing exercise to get a feel for the company and what their approach to an issue is and how they kind of operate. And to give one example, which I think kind of would fit into what I'm talking about here, is, say, recently in the UK, there's a big inquiry at the moment into a social housing fire from a few years ago, the Grenfell fire. And there are various insulation manufacturers which have kind of been implicated in different ways in that, because of their product being used on that building. And I saw recently an asset manager that I know has long held one of those companies, Kingspan, and they've held them from a position of them being a very good sustainability company. You know, everyone up until Grenfell, insulation felt like a very good thing. You know, it was helping to keep heating costs down. It was helping to kind of decarbonize buildings. But then that asset manager recently, because of the public inquiry that is ongoing, and it hasn't even concluded yet, but that asset manager has actually taken the decision, and this is part of engagement as a kind of ultimate decision, disinvestment from a company, because they've got serious concerns that hadn't cropped up previously during the engagements, but concerns about the culture of the organization, of the company, because of the fact that they felt that the company was prioritizing profit over safety. And that's something that kind of comes about, you know, the kind of issues about culture. And we see this come up with things to do with diversity and who's promoted and all of these different issues. They're kind of a little bit more subtle, and it kind of requires a longer term conversation and kind of a very close relationship between portfolio managers and financial analysts and sector specialists within, I mean, especially within a big asset manager, to be able to develop the type of understanding of how that company should be operating and how it is operating, in order to be able to raise the right questions and identify risks like that before they actually occur. That's an extreme example, but I think, you know, when we're talking, I mean, the tea and cookies that Wolfgang, for the record, I've never been given, well, actually, no, I have been given tea and cookies. Sometimes you get nothing in these meetings, which is just shocking, even pre-COVID. but that's the early point. But then, you know, there's a kind of it's an escalating set of actions that you take if you're not happy as an investor with how the company is responding to those inquiries and how they're actually responding in terms of the actions that they take. Then there are escalating steps of, say, you know, voting or raising questions at AGMs, voting, potentially filing or co-filing a shareholder resolution. And as I said, if they're still persistently, obstinately kind of not responding to those shareholder expectations and asks, then it's disinvestment. But
that brings me to the next point I wanted to address with you. Thanks, Claire. This perfect segue to my next question. We sometimes hear investors criticizing engagement as a kind of easy way to weave in some sustainability in a portfolio, whilst actually not impacting the way the portfolio is structured at all. Namely, you invest in everything within an index, a classic index, but you will say, look, I know I have some companies here that are maybe investing in a lot in fossil energy and have so practices in terms of human rights, supply chain, but don't worry, I invest, I hold the shares, I will use my influence to go at the management and do full throttle engagement to exercise change, to lead to change, and therefore overall be a force for good, while at the same time being an investor in all these companies. Of course, I'm being a bit ironic here, but starting maybe with you, Wolfgang, where should investor draw the line? Claire alluded to an example where an investor decided to exclude instead of pursuing maybe further engagement with the company. Is there a way to draw a line, or is it always a case by case? What do you think?
A very complicated question, this divestment versus engagement. I think I'd actually taken your what you just said and said that myself. That's sometimes the impression we get. You do a bit of engagement, you as the investor, and then it's all good and you can just continue with your portfolio as you have. And of course that's not the idea. But I fully agree with Claire that it needs to be escalating, and oftentimes voting should be a lot more in that escalation, and we see voting activity going up now because it's becoming in the spotlight, and people are looking, who are you voting for, and what are you doing with your votes? I think escalation, definitely. I think the timeline could be a bit shorter sometimes, but I wouldn't dismiss divestment, but I wouldn't say divestment is the answer. But actually there is a strand and a line of argument that is gaining popularity, which I think is problematic and possibly dangerous, which is saying divesting doesn't work because there's a bit of cost of capital. No one cares about that. Although I thought, again, from a bondholder perspective, cost of capital was everything. Was vitally important. But people say, no, it's just if you sell your stock, then it doesn't really make much of a difference. What you need to do is you need to engage and bring about real world impact. And this idea that as an investor you can affect real world impact is nice, but it allows inaction, because it says if you can't get a company to do what you want, then divestment isn't really the issue either. And I would very strongly say that if you can bring about real world impact, that's fantastic, then do that. But if you can't, you're still financing something that's contributing to global pollution, and that creates a responsibility. Whether you can do something about it or not doesn't matter. If you finance it by being invested, then it's your responsibility. And divesting is, if engagement doesn't work, is better than not. And so I would say the other idea that divestment is completely useless is problematic as saying engagement isn't the solution.
Do you agree, Claire?
It's a tricky issue, and I think that certainly is we use both of those or approaches, and also, I mean, a lot of we have passive investments, so not actively managed investments as part of our portfolio, and something that the Pensions Board did a little over a year ago is with FTSE Russell, and this is not financial advice, it's not a hard sell, but just to mention it because it's relevant here, but we introduced something called the FTSE the FTSE TPI Transition Index, forgetting the name of it for a second there, which
Transition
is based,
Pathway Index, right?
I was going to say TPI is it's the Transition Pathway Initiative, which is a climate data assessment tool which the Pensions Board co-founded back in 2017, and which we still chair. Adam Matthews chairs it. And that's a partnership with FTSE Russell and the London School of Economics. And basically that's assessing and grading companies across a whole range of industries on their management quality and carbon performance, and to ratchet the effect of that, and also to help with the decarbonisation of our own portfolio. Last year we created this index, which is investable and is attracting more assets month on month from other investors, but the holdings within that passive index are weighted according to how those companies are performing in the TPI. also within the index, there are companies that aren't in assessed as yet, but it really helps to kind of minimize our exposure to some of the companies that are really not stepping up sufficiently and are still at the kind of starting kind of stages of showing that they have a handle on needing to manage the risk of climate change.
So if I understand you correctly, related to what Wolfgang said, it's not in or out, it's a gradation from the smallest weight in this index for the worst companies to the biggest weight for the best companies.
The worst rated companies in TPI are not the ones that are, you know, failing on TPI's assessment criteria are not in the TPI index, and then it's kind of gradiated from there. Aside from that, which is our passive kind of allocation, we also, I mean, we the same as any investor or responsible investor, maintain a list of a set of companies that have been excluded for different reasons from being part of our investable universe. So that could be because we have they contravene policies that are set by our ethical investment advisory group on, say, things like controversial weapons or issues such as that, or because they have previously, you know, we've after escalation of engagement tactics, we've just taken a decision that they're, you know, to be colloquial, you know, there's no hope for them.
Okay,
and that
so
actually
in
we
that
need
case,
to
you
disinvest.
exclude.
Mm-hmm.
But just let's come back to the engagement process, if you don't mind, because what I understand so far in our discussion is that engagement can work. It's a lengthy process. It requires resources, and there should be a gradation, a form of escalation as you move along. So implicitly, you need, as someone in the comments question box said, you need good practice and a way of tracking effectiveness of your effort. So I think it would be interesting now to maybe compare engagement with investor activism, which is what has been around for a long time. People take like a hedge fund takes a stake in a company, sometimes a very small stake compared to what they managed to achieve, and then they using that stake they manage to create change. And sometimes, as we have seen recently in a French famous dairy company, dramatic change. So how come when small investors holding 0.05% of the capital, they manage to get the management out? Investors holding sometimes 10, 20, 30% of the capital, joining efforts, barely managed to convince the management to issue a credible plan on attacking climate or sort out their human rights violation in some countries. I think Wolfgang, something that was interesting, was dear to your heart.
Yeah, I mean, that is a really good question. And I slightly disagree with Claire on the time and the resources needed, because I think you can sort of speed it up quite a bit, and these shareholder activists do. And you can see change in, you know, CEO, chairman out within months without taking a lot of time. I mean, sure, they put in resources. I think there's a big difference in objective. Obviously, the hedge fund wants to make a quick buck and be on their way, versus engagement that investors like Church of England is doing. That's really for the long term. So the objectives couldn't be more different. But from a tactics perspective and from the way they go about things, I mean, that's what engagement should look like. And I'm thinking, yes, I agree that there's topics where you really don't have the answers, and you need to have a conversation. That is very true. And working for an NGO, we sometimes simplify a bit too much. But I think engagement in this day and age on particular things like climate, where there are answers, could be after the AGM, you send a one-pager to the company saying, these are my expectations, and if they're not met by the next AGM, I'm voting against the board. And that could be very powerful engagement. Not the nicest, but you know, when it comes to climate, we've been told this decade is crucial. So this circle of 18 months, and then we review and we reward companies that have gone a little bit further. It's just we don't have time for that. And to be maybe a bit controversial, looking at the Climate Action 100 benchmarks that have been published a few weeks ago, the targets, none of them look very good. None of them is even remotely in line with what needs doing. And so the question is, for the last 4 years of Climate Action 100's existence, what have they been doing? I mean, were the companies so bad that this is already an advance, or is it that we've just given them too much time?
Claire, I think you you see me coming here. I don't want to put you on the spot, really, but as you are a member of Climate Action 100 Plus, you just heard Wolfgang. We are as well at Candriam.
I was just about to say, right back at you.
Yeah. And so I'm happy to chip in.
No, yeah. I mean, like CA100 is what a kind of network of 500 or so, 500 upwards, different signatories. I think they all maybe have their own flavor of what it means to be a CA100 signatory. I know from my interactions with the group, you know, that there is a high level of ambition amongst the lead engagers and the secretariat to really push for change, and that, you know, it is happening. Yes, it's frustrating in some ways that things are not faster. I think the benchmark, I mean, certainly I was cheerleading for that, or when it was introduced the tail end of last year, because I think it gives a really good clarity for companies and indeed for investors, be they engagers or kind of part of the supporting kind of crew, to understand what it is that the expectations really are, what the standards are, and what the timeline is for achieving those. And I mean, it was mentioned at the start, say that the pensions board co-leads within the IIGCC, which is the institutional investor group on climate change, which is the kind of European implementing partner of CA100. We co-lead the engagement work stream on corporate climate lobbying. Has there been progress on that in the past kind of 2.5, 3 years since that was introduced? Yes. Is it frustrating that there hasn't been more progress? Yes. Is there more in the pipeline? Yes. But, you know, I think certainly I'm, you know, at the stage where there's currently 25 companies that have published reports. There are more coming this year, but certainly, you know, I'm running out of patience personally with the kind of the reasons for companies not providing more disclosure on, importantly, their governance of corporate climate lobbying, but the alignment of how their activities are delivered, because what we're seeing and where the risk comes in for CA100 members and investors in those companies is that there's that risk that's ever kind of present of greenwashing, that a company says we support the goals of the Paris Agreement, but then actually they are either directly through their own activities or indirectly through the kind of support that they give and the resources that they provide to industry associations, that they are getting in the way of ambitious climate policy. And the words, you know, I mean, you're constantly hearing, oh, we need a level playing field. Everyone wants a level playing field, but it seems that no one wants to stake out the kind of, you know, the boundaries of that, the kind of are not actually wanting to be kind of playing the game properly. It's sort of, it can be a very convenient way, I feel, of delaying and saying, well, we'll wait for the regulation to catch up to tell us, you know, we don't want to put ourselves as a company at a disadvantage of others in our sector, but that then actually behind the scenes, they're actively seeking to delay or dilute the type of policy that, when implemented, will force them to change their ways, or will incentivize them to change their ways. You know, I think it's a classic case in point is sort of what you see with the auto industry, really, which is obviously a big user of fossil fuels and various other kind of, you know, rare minerals and natural materials, but they, you know, they're not moving fast enough, and they're kind of wanting to have their own competitive advantage in place before the regulations come in. And we saw it in the UK with the government trying to ban diesel cars within the next few years, and that got pushed back because of lobbying from the industry. So as a sort of a first point, really, of driving progress, but driving progress on this, it's to get companies to kind of, you know, put their cards on the table and say, this is what we believe in terms of how we see our role in support of the Paris Agreement, and this is how we're delivering on that, so that investors and other stakeholders can actually, you know, really judge who's leading on this and who is just playing kind of delaying tactics. So, and that's all within the kind of environs of CA 100. So there's multiple different engagements going on, but it's frustrating.
Let me ask you then this. For an engagement campaign, a collective engagement campaign by definition, is there such a thing as too many members, where you grow, you start with a few people like yourself, like Wolfgang, who have a very clear line what companies should do and should achieve, and this is your only message. And then maybe as you add investors and your campaign grows, then you start diluting the message, because as you get more investors, maybe not everyone's on the same line, and you don't have a unique view anymore. But you can say we speak in the name of XAGillion euros under management. Wolfgang?
Well, this XAGillion is interesting because you know, 54 trillion, I think that's half of the world's complete total market capitalization. So basically it's half of the world in that alliance. But in a way, they're not working as a collaboration. It's like you have a horde of Vikings running towards a village.
Yeah, I didn't want to target CA 100 plus.
No.
Specifically, it's not about making the.
It is true for other collaborations as well, and it's also true for the bond side. And the problem for the bond side, you have a horde of Vikings running towards the enemy, big scary guys, and then they don't strike in one, but one by one they need to go through a little door, because they don't want to be seen as acting in concert or as acting anti-competitively. And that, to me, is a big problem with it. You can argue 54 trillion, but if the 54 trillion don't dare saying this together, and every investor is in the end working for themselves because they feel that the Department of Justice or someone else will say, you weren't allowed to do this, then that's not really the force of the 54 trillion. And if you can't, I think that's what collaborative investor engagement is struggling with. How can we make this 54 trillion really, because if they all voted, if a company hasn't done something in within 12 months, then the change would be there.
This is a very good point you're making. The fact that in some jurisdictions, investors cannot be seen to be acting in cohort. So even if you have an engagement, collective engagement, at the end, as you get to the AGM, everyone has to act separately. Is it the case? Is any one of you able to share any more clarity on this? Does it apply in every country or only in some jurisdictions?
I mean, so many of these things, do come down to different corporate governance codes. I mean, we co-filed a resolution in the States on human rights last year, and despite the fact that we were part of a group that had co-filed, there was then a whole level of complexity about how we even communicated within the group about that filing ahead of it kind of being on the ballot, in order to not fall foul of it's not so much not being seen, it's not suffering the kind of legal consequences of being seen to be acting in concert, which is for something as well, not to take it back to CA 100 again, but it's different where it's about engagement. It's then about how the actual formal influencing of the company via, say, the mechanism of the AGM and voting. Because if there's a group of shareholders that have got over X% of the company, then that needs to be kind of declared as being, an active kind of interest, and that would be where things get a little bit sticky. To go back to the point about, I suppose, the level of kind of dollars behind assets under management behind things. I mean, it's an interesting one, really, and it comes back to this sort of starting question as to how change happens, because I think I've definitely sat in meetings with companies where I can see that they've got particular names highlighted on the letter that they've got in front of them, because they're names of investors that they know will follow through on kind of escalating things if they're dissatisfied. So I think it very much, there's the broad tent of an overall engagement, and then there's how people actually engage in a tangible way as part of those meetings and follow up. And I think, that there's an interesting example, I think, in the way that ICCR in the US, so that's the Interchurch Corporate Relations, anyway, I forget quite what their name is, but they lead a big network of investors. But the way that they kind of do a little bit of the lifting and the coordination, but then that it's up to the investors to sort of put their hand up and be like, we want to be the lead on these particular companies, and we'd like to play a supporting role with these companies, and that we just sort of want to be sat at the back of the bus for these other engagements. That it's kind of depending on the level of sort of relative importance that a company has within the investor's portfolio. I think that can be a good way of sort of spreading what is actually can be a resource intensive kind of work plan. If you're engaging, you're engaging across multiple different issues. As a asset owner, a pension fund, we're a relatively small in terms of AUM. We also then would be raising all of these issues that are priorities for us. We'd be raising them with our asset managers. But fundamentally, in what year are we in? Last year, 2020, we engaged as a team of kind of 4 overall with something like 675 or 680 companies. And those companies, they weren't necessarily just being engaged on one issue, because we were working across multiple different priorities, say the tailings dam issue, Indigenous rights.
Sorry to interrupt you, Claire. What you're saying is the more investors you have, the more you can spread the effort across members. It spreads the effort,
and also, which of those investors as well will hit the right nerve with the company, because they see them as being actually a stakeholder that they should be giving more credence to, and you never kind of quite know that.
Okay, no, it makes sense. Yes.
I would say from our own practice, this year we filed a resolution at Tesco asking the company to come clear on a target for healthy foods in their sales, and it was a handful of investors, 2 handfuls that supported us, and many individual investors, but 10 institutional investors. It doesn't have to be a lot. In this case, they have to be credible. And so, yes, as Claire said at the beginning, it's good to have been doing the homework, but you didn't need trillions and trillions. And in the end, Tesco said, okay, yeah, that does make sense. We'll do that. And we ended up withdrawing the resolution. So I'm just thinking
Yeah,
to your point.
I think you're downplaying the homework that ShareAction would have done ahead of that. I'm not sure your colleagues will appreciate that comment, Wolfgang.
No, I don't want to do that.
It sounds very simple, but actually, can you elaborate a little on that, because it's a very tangible example of where engagement led to a very positive change. And I think I read Tesco has now committed to increase the share of healthy food in its supermarkets on the shelves. And that's a direct consequence. Of course, you are part of a social trend towards healthy food. It's not like it's not just because of you, but still, it was a kind of that what triggered.
It was a first in resolutions in Europe, at least focused on food. And our healthy markets team has been around for 3 years. This whole topic is relatively new. We're trying to develop it, healthy, health as a public health as a topic. And so before the climate crisis, not the climate crisis, I'm sorry, before the COVID crisis, people were sort of, but let's focus on climate first, and then we do the health thing later. That has dramatically changed, which helped us. But still, it was hard to convince investors that now is the time to bother the UK's biggest supermarket with those topics. And there were all kinds of arguments. I mean, you hear them all when you try to convince investors to support this. But if there's a few that say, and it's very different from big asset managers to small asset owners that say, yeah, that absolutely makes sense, and we see that this is totally in the interest of the company itself, and others competitors have done that. So it's almost a no-brainer. Then you go to the company, and the company at first says, normally you're a pesky NGO. What do you want? We know how to do our business. But if you have some reputable investors with you that have been engaging, then that helps a lot. And then you can get into a dialogue. And then the question is, and that is the power of resolutions, is companies aren't particularly keen on having to put that onto their ballot. So they try to talk you out of it, or find a consensus. And if you sort of get out of the company what you wanted in the resolution in the first place, then that's a win-win, we would say. And it's not about trying to push companies to do what they don't want. That doesn't work. It's about trying in the first instance to make clear that a lot of this is in your own interest. You just need to have a horizon that's a bit longer than the next 4 quarters.
Yeah, and that's how you enact you're most likely to enact change, is because your interest as an activist are aligned with society's interest and ultimately the company's interest. And when everything aligns and you manage to convince the company that it's the case, then you get change. If you allow me, and usually I don't do that, but since Claire, you discussed a bit of product placement with the TPI index, and now Wolfgang with this initiative. So I do a bit as well, because we have reinitiating an initiative at Candriam on facial recognition, and the fact there is 1 billion cameras currently worldwide looking at us. So this is exactly what we've been discussing, a collective engagement initiative aiming at going to the companies that are manufacturing these cameras or using them very actively to collect data, and first of all, try to understand what exactly are the policies in place to protect our privacy and our basic rights, including in some regions human rights, because these cameras can be used to control people. So just that's it. I won't go any further, but something also to ponder upon. We have only 6 minutes left, and there are so many other topics that I wanted us to discuss, but one of them goes back to you, Wolfgang, but then of course we also thrilled to hear what Claire has to say is about bondholders and whether engagement is feasible at all as a bondholder who doesn't hold equities. We got a question initially here from someone not only asking whether it's possible, but going further, is there not actually a conflict of interest between a bondholder and a shareholder, both going to the management of the company, knowing that they have different, of course, pecking order in the capital structure, maybe different interests, different time horizons. What are your views both on this this relatively new development, bondholder engagement, I would say?
The first question, is it possible? Absolutely. Probably a lot more powerful. It could be, because as bondholders, if you don't provide capital when the bond gets matures and gets reissued, then the company has a problem, and that's a cash flow problem that you won't have the same way with equity, because equity is permanent. So there's a lot of power. The problem being the collaborative angle, because if you do it as on your own, it's not going to move the needle. If you could do it as collaboration, then that would be amazingly powerful. Unfortunately, you can fall foul of market manipulation, acting in concert, antitrust behavior. So one of our projects, hopefully, is going to be very soon to figure out how to go about that, because we think that is what bondholders could do. On the conflict of interest, yes, absolutely, is there a conflict of interest? And anyone tells you that bondholders and equity holders have the same interests hasn't experienced a dividend payment financed with releveraging the balance sheet. The problem is, the question is, what are you pushing for in the engagement? Because if it is about, if we take the EU term double materiality, if it is about outside materiality, about climate Paris, then I think, yeah, absolutely, you can be aligned, trying to hold global warming, equity holders, bondholders. If that's their interest, then that is aligned. What isn't aligned is to say, and that comes back to what you've just said, that in the long term, economic interests and society's interests converge. Well, not necessarily. And if you argue that certain climate policies are economically positive for a company, then it gets difficult, because then equity holders might have a very different view from bondholders.
Claire, anything you'd like to chip in on that question?
I mean, certainly a lot of my work focuses on equity engagement. So with the publicly listed companies that we have shares in, but an area of work that we're developing, or I'm looking to develop at the moment, is about kind of housing. That relates to a report that the Archbishops of Canterbury and York put out earlier this year called Coming Home, about kind of affordable housing and general community sort of crisis, again focused on the UK. But we're going to be looking at how to engage with the housing associations and housing providers and developers that we hold, and many of those are via corporate bonds. So that's definitely not an impediment, because we have a financial interest in those entities, and these things have financial implications as well as societal implications. So we have the kind of fiduciary duty side of things, that we need to make sure that we're generating returns. Obviously with bonds, those are fixed far into the future, but there's also, the looking from the ethical side and the sort of wider duty that we have to kind of think, well, what about social license to operate of these different institutions that we invest in, and also the impact that they're having on the world, and is that the kind of type of world that our pension beneficiaries want to be living in and want to be retiring into? So it's certainly not off the table at all for looking at fixed income.
Thank you. So what you said both is, as a bondholder, companies, as issuers of bond, companies need to refinance their bonds regularly. Otherwise, as Wolfgang said, they have cash flow issues. So even if you don't have a share to exercise a vote, still they will need to come to you to ask for more money every few years. And at that point, you can then have a discussion, preferably before that and on a regular basis, to discuss maybe some common interest between equity and bondholders, even if, as you said, these interests do not always are in agreement. And one final, very small question. We're already on the mark. Just very quickly, maybe 30 seconds answer, if you don't mind. Is it possible, in your view, to delegate engagement to a third party, or it's something really that the shareholder holding the shares has to do it himself? Or sorry, Claire, go first.
So, I mean, as I mentioned, we're a relatively small pension fund with a relatively modest sized team. We have asset managers that act on our behalf. We're very clear in appointing those asset managers of the standards that we expect and the level of engagement that we expect from them. And we have regular manager monitoring meetings with them to make sure that, you know, they're actually delivering on that. So I think where you've picked, I mean, the same as picking the right companies if you're not passively invested, but picking the kind of asset managers that align with your policies and your interests, then delegating in that respect. Again, you know, that they bring more assets under management to the table in terms of just their individual engagement. So I think there can be benefits there.
Okay, Wolfgang, anything to add?
I think it's certainly possible. At ShareAction, we do an annual voting analysis. So we keep tabs on how the big asset managers that you've delegated your engagement and voting to are going to perform. I think it's possible, but as Claire says, it needs to be very clear what is expected and what engagement is supposed to achieve.
And just
Yeah.
ever so quickly, from our point of view as well,
Sure.
that's an additional point of influence and leverage because we are clients, they want to retain us as clients, so we can kind of help to move the conversation if there's something that they're not engaging on or not quite on the same page with. That's a means of us engaging indirectly via them as well as directing, you know, our own engagements internally.
Thank you both. Thanks for this fascinating discussion. I think we learned a lot thanks to you today about engagement, and make sure to audience to tune in for our next ESG talk, which will be about the US, and we'll be exploring what's going on in the US since January from an ESG perspective. Thanks for watching. Until next time, goodbye.